Hi, I'm Adrian Helfert, CIO of Multi-Asset at Westwood Holdings Group. Thanks for joining us today. We hope to give you a flavor of where we've been in the first half and what our outlook is coming into the second half and looking forward. What a first half it has been. So I think somewhat of a recap is in order for it. Inflation metrics have shifted into higher gear, but more importantly, they didn't slow down as much as the Fed expected last year when Chairman Powell used the word transitory and was expecting before hiking rates too much that inflation might start coming down. That hasn't shown through yet, and the Fed has shifted into high gear. Now, that's a good thing. And we see the market being receptive to high gear in its response to, as we saw this last time when they hiked by 75 basis points. But that removes us from a historical, the last decade or more, being very accommodative or market friendly to risk markets, to equities, to corporate bonds. By the Fed's own estimation, though, this inflation is only 30% driven by demand. 50% of this inflation is driven by supply side issues, 20% from other factors. The Fed's base rate and their balance sheet is a really blunt tool for controlling geopolitical impacts on supply chain issues, impacts from things happening in China. Pulling the punch bowl usually impacts elevated demand, heightened risk in markets. That's not the big driver here. Markets have responded in kind that, okay, well, the party is over and inflation is still rising. The long bull market that we have seen over multiple decades looking over as well. The S&P 500 being down nearly 20%, which is why you probably saw headlines around a bear market. We've appreciated a little bit from there. The return of a U.S. Treasury bond of a 10-year maturity has had the worst start on a first half since George Washington was president. Not George Bush, George Washington, near the formation of the United States. That's how difficult it has been. Now, given the drop in expected economic activity this year and next, the word recession is thrown around quite recently and increasingly as well. So that's the backdrop. Now sets the stage for the second half. That doesn't mean all things are bad. The market generally realizes where we're going well ahead of when we get there. So looking forward, we do see a decline in economic activity that is spread across the economy and lasts more than a couple of months, which is the National Bureau of Economic Research's definition of a recession. But that's not starting this year. The consensus is nearly there. The consensus is around 30% possibility of a recession in the next 12 months. The consensus is that earnings are going to be dropping in the future. When that is a consensus, markets are reflecting that. So what we see right now is what markets are reflecting and anticipating that future. So the positive element of that is there is some upside as we can do better from here. Valuations have dropped substantially on the S&P 500, but just keep in mind we're only about average on forward-looking price to earnings ratios. Now, we believe that some stocks will have further to fall. At the same time, we believe that some companies are currently undervalued. Our goal is to find those undervalued opportunities and invest in those. Interest rates have become more attractive as they have risen substantially. The 10-year U.S. Treasury bond that we just talked about, historically, it tracks economic activity on a real basis, ex-inflation. Right now, it's over 3%, which is double the income from where it started the year. So it's become more attractive for income-oriented investors to have some income and fixed income exposure with good selection for strong balance sheet opportunities. Corporate bonds are actually decently positioned in this environment as well. They have been negatively impacted. Our good selection, finding those that are resilient in markets like we see going forward, will provide us with both good income and capital appreciation opportunities. As the economic cycle goes, you may have heard me speak before about having a simple framework for an economic cycle that often starts with consumer confidence, leading to consumer spending, leading to investment from a capital investment perspective, more jobs, more wages, consumer confidence. Consumer confidence is low. That's a ding in the side of an economic cycle. That said, savings are significantly improved over where we were during the last large crisis, the global financial crisis. We don't have the leverage on consumer balance sheets. We don't have the home equity borrowing to go buy the fancy red car. We have much less of these things that lead to a significant retrenchment sharply in economic activity. Unemployment, of course, is still a tailwind. It's very low. Job openings are very high. We actually have room to rise on unemployment and I think still be supportive as an environment. Mortgage rates have risen from very low mortgage rates. Up standard 30-year mortgage is up around almost 6% now. Housing prices will likely drop on the back of that. Not unexpectedly, but the good news is we expect less of the possibility of a sharp correction in housing prices. So while on one hand, the past market is down, on the other hand, the future is cheaper. We find good opportunities for investment by digging through those downtrodden companies. We still look for some companies to not be able to weather the environment as well. Our goal is to, by fundamental analysis and by allocation, avoid those downside risk. We still think that before taking an improved outlook on the overall environment, that we want to see the whites of the eyes of inflation coming back down. That will drive the Federal Reserve to be a little bit more accommodative, to not give a forward element of the party is simply over and people are leaving the party. That's a key metric for us to observe is realized inflation and when it starts coming down. And usually we are looking at core inflation. Energy prices are likely to remain elevated, which is one reason why on a sector basis, we still think the energy sector, which has been by far the best performing sector in the S&P 500, we still think it has a pretty rosy outlook, and we are overweight the energy sector. Cash flow and quality do remain king in this environment. We are fundamental investors. We are looking for those good quality companies which will realize good returns for investors in the future. That's a good news for us because that's our sweet spot. We'll continue finding those long-term opportunities for you. We look forward to keeping insight coming to you, and please feel free to reach out and ask questions. One thing to always remember is that the market sees forward, not now. And businesses don't just sit still, they adapt. They adapt to new regulations, they adapt to taxes, they adapt to new business conditions, they adapt to new COVID-type demand, supply chain concerns, all things that we are seeing now. And this plays, I think, very well into our hand as being cash flow oriented, high quality investors and finding good opportunities. Thank you for your time. We'll see you soon.